Okay, we are recording. Okay, so this class is called Art of the Deal. And our goals for today is for you to be able to understand the basic timing requirements in the contract and to become aware of various forms, addenda, amendments, and such that may be part of the deal. So components of the deal, these are a lot of things we're going to talk about today. We're going to talk about title commitments and objections, surveys, home warranties, HOAs, lenders, and appraisers. So anytime there's a question, just let me know. Okay. Talking first about title commitment. What is a title commitment? It is a title company's promise to issue title insurance after the closing of the property. And basically, it is identical to what the title policy is going to look like. It's a precursor to that. And the purpose of title insurance is to protect buyers and lenders from errors and defects in title. And as you know from the contract, it is a negotiated point on who pays for the title policy. Traditionally in Texas, sellers have paid for it, but the last year or so when the market was so strong and multiple offers and people trying to make their offers look stronger, a lot of buyers have been paying for it. And then the buyer does also pay the lender's policy. That's not addressed really in the contract, but that is how it's normally done. And title insurance rates are set by the state of Texas, the Insurance Commission. And, there are a lot of calculators for title insurance premiums online. So if you're working with a client and they want to know how much it's going to be, if you just Google Texas title insurance calculator, you can plug in the amount of the sale and you'll get that amount because it's regulated, and therefore it's universal no matter what title company you're closing at in Texas. The title company orders the policy, and the policies are valid for as long as the owner owns the property and the lender has a lien. And in the TREC 1-4 contract, it says that the title company has 20 days from receipt of the contract to produce a title commitment. Usually it's a lot quicker, usually within about a week, you get it in. So, and then there are set numbers of days in the contract that the buyer has to review and object to the title commitment once it arrives. The seller has 15 days if the buyer, so the buyer, that's a blank you fill in. So obviously the buyers usually want a longer period and a seller usually wants a shorter period. So if the buyer does object within the period is set forth in the contract, then the seller has 15 numbers of days to cure any defect, and that's called the cure period. And then if it's not cured, the buyer has 15 days after that cure period ends to either terminate the contract or waive whatever the objection was. And in terms of objections, people usually put in there, a lot of times it has to do with constructing a new home. They'll put something like construction of new 2-story home of at least 4,000 square feet. And let's say you get the title commitment back and you see that there is something in the regulations saying that now only 1-story homes are allowed. That would be an example of something. Or they put construction of an in-ground swimming pool and you get the survey back and there is a big easement that is running through the middle of the backyard. So those are kind of common examples of objections that a buyer would likely write. So looking at the various parts of the title commitment, they're called schedules. There's Schedule A, B, C, and D. Schedule A, which you can see on the right, involves the details of the transaction. and it sets forth the amount that is being paid and the loan amount and the parties involved. So, and then down at the bottom, it's saying in number 2 that it is a fee simple, which means it's a full interest, is what the type of interest that's being conveyed from the seller to the buyer. And that the number 4 is very important. That is the legal description, and that should match what is in the tax rolls and what was put in the contract when you made it, because it is the legal description, not the physical mailing address, that is what conveys. That's so, you know, there's horror stories out there of people who have, you know, put in the wrong lot number and sold the wrong house. So, just always be cognizant of that. And then hopping above to number 3, the legal owner. Always, that's the seller. So we have to make sure it matches the contract, and kind of an frequent time when there are issues having to do with marriage and divorce. So that would have to be addressed, and the title company can help you with that. Like if the seller has divorced a spouse, they may mean, and now the spouse is no longer part of the ownership, they may need, you know, proof of the divorce filing. And then also with death within a estate, they would probably need some kind of documentation from the probate court. All right. Okay, so the next schedule in the title commitment is Schedule B. And this schedule is directed at the buyer and the lender. And it lists the general and specific exceptions to the property, such as survey matters, taxes, easements, setback lines, and other items that are not going to be covered by the title insurance policy. So this is kind of saying what is not going to be covered. And there's lots of standard language from the Texas Department of Insurance. That's on all policies. And so that's really not changeable, but specific, other specific examples to the property have to do with building lines. You can see over on the right-hand side under 10E, it'll say 40-foot building line along the front of the property, you know, so that's like something that's showing, you know, you can't build houses any further. So, and that might, but as I was talking about before, might be a situation where, you know, if someone was wanting to build a house of a particular size or something, but they really needed to go further up in the lot, you know, or also on the sides, they have it too, the building lines that may become an issue. And then also, like if it's a historic district or conservation district, that would be something that would be listed in here. And if there were any like boundary line or fence lines, sometimes people do those, neighbors do them between themselves, and they file it in the records. Those would show up here as well. The next section is Schedule C, and this is called the clear to close section. And these items are really directed at the seller and items that they need to take care of. And again, the title company helps them take care of it in order to be able to close and properly convey title to the property. It largely has to do with mortgages and liens. And sometimes there are tax liens and abstracts of judgment. And if that is the case, you know, it may take a little bit of time to resolve that. So, and then Schedule D is just disclosures of parties with interest to the premium. So it's just a legal disclosure of people who, you know, have an ownership interest in the title company. So again, all title commitments will have these sections. And then the next section has to do with the survey. Surveys are not required in Texas, and occasionally we will see transactions. Usually they're small, dollar wise, and they um, they are cash transactions, because a lender is going to want to see it. And then, of course, if you're selling a condo, there's no survey required, because you're just buying the interior walls of the unit. So, but surveys, as you know, on the next page, it must be, there are 3 different choices you can check having to do with who provides the survey. Let's go to 2 and 3 first, because those are a lot more straightforward. It is just saying either a buyer is going to obtain a survey at buyer's expense, or 3 is that the seller is going to do it. And surveys, for a normal like house in a subdivision, thinking $600-ish would be the cost. Of course, if you're doing a bigger, more complicated piece of land or something, they can get really expensive, but just for normal residential, that's just a number to keep in mind. Number 1, you check when there is an existing survey already and you want to try to reuse it, which would save, one of the parties $600. So in such case, there is an accompanying affidavit, the T-47, which is filled out by the seller in conjunction with the existing survey. And they would have to go to a notary, and they would state that they are the owners of the property and they're familiar with it. And number 4 says, to the best of our actual knowledge, since blank, there have been no construction projects such as new structures, additional buildings, rooms, garages, swimming pools, or other permanent improvements. And what's important there is the date. The date that they are going to attest to there is going to be the date that is on the survey. So, when this becomes kind of confusing sometimes is, let's say they had bought a house in 2020. And then they used a survey then that was from 2005. And that would be the date down there. Well, they can't really attest to what happened, in the 5 years prior to their ownership. So really, a survey if they're going to reuse a survey, it needs to be a survey that they obtained in conjunction with the purchase of their property or a refi or whatever. You really can't go back, because one of the reasons is they don't have any what's called privity of contract with that surveyor. They didn't know in 2005, when they had no interest in the house, they had no relationship with the surveyor. But if they had bought it, if they had had a survey done when they bought the house in 2020, and then there becomes an error, then they have a relationship and can go back and have a legal claim against the surveyor for a mistake. Does that make sense? So, and then you note on this, you note any changes that have been made on the survey affidavit. So, if there, like say, a new fence was constructed, or a pool was added. So you can note these, and sometimes title company and or a lender are really specific and don't want any changes. Sometimes, like let's say a fence was replaced, but it was replaced along the same line. I've seen them go both ways. I've seen them say no, even though the fence, is on the, the fence is never going to be perfectly exactly like it was in that survey. So you got to get a new survey. And I've seen other title companies and lenders say, well, that's okay. So, but back to the language in the contract. So if you are using this survey and existing survey and survey affidavit, it is imperative that you get both documents delivered to the buyer by the times set in there. If you just do the survey, but not the T47 affidavit, it doesn't count. And then even if probably the survey would have been reusable, then the seller is the one responsible for then paying for a new survey. And usually that's because of agent error, and you are usually the one having to pay for the new survey. So, home warranties. These are third-party home warranties. They are service agreements that recover the placement of many major home system components that break down over time due to wear and tear, such as electrical, plumbing, heating, air conditioner, and home appliances like dishwashers, stove, other built-in things like that. And the difference between a residential home warranty and home insurance is that home warranties are designed to protect your home's appliance and systems from breakdown, just normal day-to-day things. Whereas homeowners insurance has to do with casualty and unexpected events, weather-related, like hailstorms, tornadoes, fires, things like that, but don't really deal with appliances and breakdown day to day. So there is just to be aware whenever you do, I would say, in a non-super competitive environment, sellers are pretty willing to pay for this kind of dollar amount. Probably the lowest level would be probably around $700, for maybe a small house, maybe a condo or something. And then as you get bigger houses, they become more. You can talk to there are lots of companies out there. You're probably aware with them. American Home Shield is a big one. There's Nations, there's Old Republic. You've probably had some come to your office and talk to you. But there's a new one called, I'm going to say it wrong, Akasha. Have you heard of them? They have kind of a little bit different business model, but people are starting to use them more and liking them. But you can kind of find out that amount. And of course, if the amount you put in the contract doesn't fully cover it, let's say you put $700, but you find out it's going to be $1,100, then of course the buyer can pay the $400 difference to get the policy he or she wants. Usually the policies don't start until 30 days after the closing. This, is probably largely to help prevent fraud. Like, let's say you knew your air conditioner went out, 2 days before closing, and you're going to kind of wait and have it addressed afterwards by the warranty. So usually 30 days is kind of a industry standard for when it would kick in. Okay, homeowners associations. Homeowners associations are organization in a subdivision or community or condo that enforces rules related to the property and their residents. And if you purchase a property that is part of a mandatory homeowners association, you will immediately become a member and are required to pay dues. Homeowner associations have a board of directors and governors elected to enforce and oversee the rules and regs. The document that describes the specific rules and regulations within a homeowners association are called the CC&Rs, which stands for the Declaration of Covenants, Conditions, and Restrictions. Different things that may or may not be allowed. Some have very stringent architectural committees, like you have to, before you can do any exterior painting, you have to go through them. And, some are things that are common. You see no campers and trailers parked in front of the house, fence style and height. So there are there are both good things and bad things about being a member of it. It definitely helps create conformity and, keep the standards high. But if you are really creative and, want to do something a little outrageous in terms of with the exterior to your home, then it may be an issue. So in the contract, the TREC 1 to 4 contract, there, if you're doing that, so you're in an actual subdivision versus in a condo, there is this addendum you would need to attach, and it's the addendum for property subject to mandatory membership in a homeowners association. And there is what is called the subdivision that has to be delivered to the buyer within a specified number of days so that they are aware of all of these rules and regs. There are 3 different boxes to choose here. One is that the seller has already, the last one is that the buyer has received and approved the subdivision information. And I encourage agents that when they are selling a home within a mandatory homeowners association, that they try to get the CC&Rs up front, because some companies, they're all managed differently. Some you can get them in a day or two, some it may take a couple of weeks. And so then you're running against the clock on these deadlines. And something else says, if you're looking under A1, that once they receive the documents, they have 3 days. They have 3 days in which they can cancel the contract, and that doesn't have, it's basically like another option period. It doesn't have to be that there's something they don't like in the CC&Rs. It can be anything. People use it all the time as an excuse to get out. In fact, like last summer when the market was so hot, people were doing away with option periods, but if they had like this provision in there saying, well, if it makes, at face value, it looks like I don't have an option, but really they haven't delivered the CC&Rs and subdivision information to me, so I really do have an option. So just be aware of that. So that's why it's good to have the documents already. They're usually good for 90 days. So that should probably, last you throughout your listing period. And it's just one more, deadline you're not having to count and be worried about. If you look down on B under material change, it says that if seller becomes aware of any material change to the subdivision information, they will promptly give notice to the buyer, and the buyer may terminate the contract if there is substantial change. We've seen this a lot lately in respect to limitations that so many subdivisions are enacting, having to do with short-term rentals like Airbnbs. And maybe they haven't updated the CC&Rs yet, but there was a meeting, 2 weeks ago where it was discovered, where it was decided. So if the seller has information of something, and that's for sure a material change like that, even though it's not yet written in the CC&Rs, they do have an obligation to share that with the buyer. In terms of fees, those are addressed in C, that there are, different fees for reserves and other expenses associated with the transfer. You put in a certain amount and the buyer pays that, and then the seller will pay anything above that. So that was a change from several years ago. It used to be the opposite. So now kind of the seller, if you're listing something, the seller would want to, find out kind of how much those fees are from his association, because it could be several $1,000s and stuff. Because usually a buyer is putting in somewhere, I'd say, $200 to $400, and everything after goes to the seller. Now, if you're selling a condo, similar information is built into the condo contract itself. There is not because all condos are part of a homeowners association. So there's not a separate addendum. But one of the key differences is that number of days from delivery of the information, whereas it's 3 days in this document. So for single family homes, you've got 3 days after the subdivision information is delivered to where a buyer can cancel. It's 6 days in the condo contract. Okay, third-party financing addendum. So this, of course, is what is attached every time there is a loan to a property. And you set forth the provisions of the loan. If most loans tend to be conventional, but we of course do see FHA and VA quite a bit. So would put the terms of the loan, like whether it's 30 years or 15 years, interest rate that's being quoted, and then the amount of the loan corresponds with the number of the amount financed on page 1 of the contract. A brand new provision to this is 1G down at the bottom of the page under other financing. This was added in conjunction with the language that just came out that was added to the new version of the contract, where it limits what a buyer can do in terms of they can no longer say that they're going to pay cash for a contract and then end up getting a loan for it. And it defines loan as, private financing too. So this would be a situation where you would fill out, like if someone was borrowing from a family member or taking a loan from, their investment portfolio, this G would be filled out. So under approval of financing, there are 2 separate approvals in this section. One, which is addressed in 2A, is buyer approval. And that has to do with the buyer's income, their creditworthiness, and it has nothing to do with the property itself. So if the buyer, is, needing, he's not fully approved by the lender, that's when you put in a certain number of days where he's going to get that all worked out. This is when the stage where the lender's going to ask for pay stubs and tax returns. So, it gives, if that amount of days is longer than the amount in the option period, it is another out, assuming he doesn't qualify for the buyer. Now, the second box under A, which says this contract is not subject to buyer obtaining buyer approval. This is if the buyer has gone all the way through the process, and or if the buyer and the buyer's lender just think this buyer is golden, he's buying a $500,000 house, but he's worth $20 million, but he's getting a loan for it, and there's no way he's not going to be approved. I mean, this definitely strengthens your offer if you check this box, because that's one more contingency that is not happening. And a risk to the sellers. So, but again, it's a risk to your buyers. So always, have that conversation with your buyer and your lender if you're thinking about checking that box, but, something to make it more favorable in the seller's eyes. Okay, B has to do with the property approval. So again, these 2 approvals are totally separate. This one has nothing to do with the buyer, everything to do with the property. and the lender's underwriting requirements. So if it has to do with insurability, so for instance, the roof is old and hail damaged, a new roof is going to have to be, unless a new roof is put on, then they are not going to insure the property. So, and then another thing, sometimes, pretty severe foundation issues could be something similar. But of course, the most common issue having to do with property approval has to do with the appraisal. And this says that if no later than 3 days before the closing, the buyer can notify the seller that it didn't meet the lender's underwriting criteria, translated as it didn't appraise, then the buyer can cancel the contract. So there is a TREC addendum called the Addendum Concerning the Right to Terminate Due to Lender's Appraisal, which we normally just refer to as the appraisal addendum. And what this addendum effectively does is water down the protections given to the buyer in the third-party financing addendum and make it, the first two sections, make it more favorable to the seller. So the first provision is the full waiver, and what it's saying is that no matter how low the appraisal comes in, the buyer is willing and able. So it's important to make sure you've looked at proof of funds to make sure they have extra cash if they have to make up the difference for the ratio. If they're doing, say, an 80-20 or a 90-10 loan, it's going to be based on how the house is appraised, is what the lender is going to lend on. So the first one is saying no matter how low it is, the buyer is going to continue on with the transaction and will make up any money necessary to make up that ratio. So this one is the most favorable for the seller and the riskiest for the buyer. Now, the second part, which is called the partial waiver, is kind of splitting the difference between what the buyer is willing to do in the situation with a low appraisal. They're saying that the buyer waives the buyer's right to terminate if the property approval is not obtained because the opinion of value in the appraisal does not satisfy lender's underwriting requirements and the opinion of value is blank or more. So let's say you're doing a $500,000 property is your sales price, and they put in $490 as that amount. So this means that if the appraisal comes in above $490, if it comes in at $491, then the buyer has to go forward with the contract and they have to bring the amount, the difference of that $9,000, that percentage in the loan, to the closing in cash, because the lender is only going to fund on or lend on $491,000. Now, so same situation, we put $490 in there, and this time it comes in at $489.99. Then the buyer has the right to cancel. They have the right to cancel, get their earnest money back. So assuming it's all done 3 days prior to closing per the terms of the third-party financing. So now the buyer may choose to move forward, even though they built in this protection. They don't have to cancel, but it is a right that they can choose to execute if they want to. The third section is an unusual situation. This has to do if buyer is putting down a substantial, let's say 50% amount. Let's say it's $1 million house and they want to put down 500,000 and finance 500,000. This section protects the buyer. So the buyer has the money and is willing to, go forward, but they just want to make sure they are making a good investment. So they are saying that if the appraised value is less than X amount, so let's say it's $1 million and they put $800,000 in there, but it comes in at 700,000. The bank is still going to lend on that because so much is being put down that it's a good risk for the bank. But the buyer just wants to make sure they are making a good investment, and so that they want an out if the appraisal says it's low. Similarly, if you're ever doing a all cash transaction, but the buyer is wanting to get an appraisal, we have language that I have or Zareen has that you can reach out to us for, basically saying similar to this, but this form, of course, can only be used with conventional loans. You can't use it with FHA or VA, and if it's cash, there's no third-party financing agreement, so you wouldn't be using it. So any questions about this? All right, moving on. Okay, the basics of negotiating an offer. Verbal or written counter offers are acceptable. There's no requirement to respond in writing, but be careful and strategic, because a lot of times, you get an offer, which is usually presented on a TREC contract, and sometimes instead of marking it up and going back, and then it's the same contract's going to be marked up 3 or 4 times, the listing agent will say, okay, they like your contract, but the price is way off. We could come back at that. So you can still do that, and just be careful what you promise, because there are some court cases in Texas where oral agreements have been viewed to hold up. So withdrawing a offer or counter offer, this can also be done verbally, but best practice is to deliver in writing. And there's this form, several forms. Let's see. Yeah, here's the notice of withdrawal of offer. So if you're in the middle of negotiating an offer, you've been kind of going back and forth and slowly getting someone up, and, the ball is in, you've gone back with a counter or made an offer, but someone else comes along and they bring you this wonderful full price offer, you can send this form to withdraw it. So it's a good form to have, and it can go either side, either the buyer makes or the seller makes, depending on where in the process you are. And then this is a good form to know about also. This is the seller's invitation to buyer to submit a new offer. So this is often used if you have a multiple offer situation. So it says, because obviously you can only counter one offer at a time, because you only have one piece of property to sell, and you don't know if you counter both of them, both could sign what you have, and then you're selling the same piece of property twice. So this form says on number 1 that the seller does not accept the above referenced offer, and it says you are invited to submit another offer, which the seller may more favorably consider if, and you can put in different terms. You could say the price is at least 800,000. Closing date is June 1st with a 2-week free lease back. Just different things. Just make it as detailed as possible. So when you get an offer back, hopefully it'll be ready to sign. We're using such and such title company. Various things like that, earnest money of at least 1%. So but just a good form to keep in mind that probably a lot of agents don't know about and don't use. Okay, sorry, the effective date. So effective date is the last date the two parties sign the contract and deliver to the other party. So we encourage our agents, a lot of people, it's just kind of easy to put that stamp in there when you're having it signed off on, and that will be the, to put the date in there. Really, it's best practice for the agents themselves to date that. So you can make sure that delivery to the other side is the same, you have control of that. So here's an example of how an execution date, an effective date, can be really tricky. Okay, I'm going to read this and you've got it in front of you too. The buyer makes a written offer through his agent to the listing agent on May 15th. The listing agent delivers the offer to the seller on May 16th. The seller signs the offer as submitted on May 17th and delivers the signed offer to the listing agent on May 18th. The listing agent emails the executed offer to the buyer's agent on May 19th. The buyer's agent calls the buyer on May 20th and informs the buyer that the seller has accepted the offer. So the effective date in this example is May 19th, because that is when the seller's agent conveys to the buyer's agent that it is signed and accepted. So even though the seller signed it on the 17th, it didn't get back to the buyer's agent until May the 19th. Does that make sense? So kind of tricky there. And if you do see, a lot of times we will get contracts in, let's say, you get it in the morning, but it has yesterday's date on it because, maybe the seller signed it or the buyer signed it after the listing agent had gone to bed and they didn't convey it till the next day. If something like that happens, let them know up front, let the title company know, let the other agent know, say, hey, this was dated February 24th, but I didn't get it to February 25th. We need to change the effective date until the 25th. So just kind of, let that, don't wait until, you're arguing an hour before the option may or may not be ending to be arguing it. Let them know up front. And because the effective date is so important, because that's when the key dates in the contract all run from. Creating a critical date timeline is very important. So you can track all deadline and manage deal expectations. Put them on your calendar. ReChat is nice in that it asks you for some of these information too. So that is helpful also. I can email you. I've got some templates that I will email you after this class that are good, to have to send to your clients so that they have it too. So kind of helping explain them and letting them know, the importance of all of this. Okay, earnest money and termination option. Within 3 days, the buyer must deliver to, and you put the title company's name in there, blank amount as earnest money and blank amount as option fee. So earnest money, usually about 1% of the purchase price. Option fee, couple of $100, maybe to more upwards of 1,000 if it's going to be like $1 million plus house. But the 3 days, it's imperative if you want an option period that the money that the option fee at least is delivered to the title company. If you miss that date, your client does not have, the buyer does not have an option period. If the earnest money is late, the buyer is in default of contract. So in such case, if someone else came along and, it's day 5 and the earnest money hasn't been delivered, and someone else comes along and makes an offer on the house and it's better than the one you have, you could sign that contract as the seller. And because the contract is in default. However, you don't have to. You can kind of wait around for it, but you know, the buyer is at risk until that earnest money is delivered. Just a word of warning. This provision was rewritten about a year and a half ago, and it's now, in my opinion, it's confusing because it's so tightly written up there. Please be careful when you are writing to not confuse the amount of the earnest money and the option money. I have a terrible horror story that happened to one of our agents in our Dallas office. She confused those two amounts. She had earnest money of $20,000 and an option fee of $1,000. She confused those two amounts, canceled the contract during the option period, and the seller and the seller's agent said, nope, you put $20,000 as option fee. And they took that amount. And she came out of pocket and wrote a $19,000 check to her client. So, I'm so, ever since then, I'm so paranoid about that. It would be nice if they would break that down onto separate lines or something instead of have it all jumbled single face there. So, whoops, sorry about that. So, and again, timing on the delivery, when we say 3 days, it's 3 days. We count all days, but if the third day is on a weekend or holiday, and the title company is not open, then it's the next day after. So if you execute something on a Thursday, that's your date. So day 1 is Friday, day 2 is Saturday, day 2 is Sunday. Your earnest money would be due at the title company by 5 p.m. on Monday. Okay. Whereas if you execute that same contract on Friday, then Saturday was 1, Sunday 2, Monday 3. It's also still due on Monday. So you count the weekends, but just if that last day is a day when the title company's closed, then you've got to the end of that day. And again, for the option period, it is, as it's highlighted below under E, time is of the essence and strict compliance is required. So if they are a day late delivering the option fee, they don't have an option. So, okay, let's see. And if you're extending the option, this is the amendment to contract form. And if you look, a lot of times the option fee needs to be extended because you're trying to get repair contractors out. So number 6 says, buyer has paid seller an additional option fee of blank for an extension, and whether it will or will not be credited. It is key also if you're representing a buyer and they are extending the option, you've got, even if it's $1 or $10, pay it, Venmo it, deliver. And so this is a change, whereas the main option fee is now delivered to the title company, whereas forever in the past, it was always delivered directly to the seller. But that changed about 1.5 years or 2 years ago. But with the additional option fee, that is paid directly to the seller, not to the title companies. Title companies will not take additional option money. So just make sure, you get that money to them. Now, one thing, usually it's like 4 o'clock and the option period's ending at 5, and, are we going to extend or what? You do not have to have that additional option fee delivered by the 5 p.m. It's a reasonable amount. I would try to get it definitely within 3 days afterwards, try to do it the next day. To get them that money, but it does not have to be immediate. You do not have to have that $1 or $10 there before 5 o'clock. All right. Moving on. Okay. Backup contract. So backup contracts are used when your buyer wants to put a contract on something that is already under contract, it's in option or it's an active kick out. So you would need to, if you're doing that, what you would need to find out from the listing agent is the date of the contract that's, in first place. And then for the date you would put there, you could find out, some people try to write it out all the way to the closing date of that contract. Some people are like, well, if it gets past, the option period or buyer's financing, I'm willing to, I'll walk away at that point. So those are 2 dates to put in there. This is important under D. If buyer has the unrestricted right to terminate the backup contract, the time for giving notice of termination begins on the effective date of the backup contract, continues after the amended effective date, and ends upon expiration of buyer's unrestricted right to terminate the backup contract. So what that means is, so you would do this backup addendum along with a contract, just your regular 1 to 4, and this would be part of it. And if you pay an option, you will have options at 2 different times. You will be an option the whole time you're in backup. So that's good for the buyer. You're not necessarily held hostage by that. You see something else a week later that your buyers want to move forward with. So you can cancel that. And then if you become the primary contract again, that's what they mean by amended effective date. That's when you become primary. And let's say you have a 7-day option in it. Then for the first 7 days while you're in primary, you would have an option. And it's fairly common if you're in backup contract, the seller and seller's agent will allow the buyer to pay a pretty nominal option fee and earnest fee, just so they know that the chances are pretty low it's all going to make. But if let's say you would do $10, like $10 for option and $100 for earnest money. And what's normally done there is you would go, so this is, again, if you're doing backup, for earnest money, you would put like $100 for earnest money. And then down below where it says additional earnest money, you would put the big amount. So if it's a $500,000 house, you'd put $5,000 there. And then in special provisions, there's language I can give you that says, upon becoming primary, within 3 days of amended effective date, buyer will deliver, the $5,000 additional earnest money. And then under option fee, a lot of people they'll do like $10 and then slash, $500. And also in special provisions, writing in upon becoming primary, they will deliver $500 option fee. Okay, this is the addendum for sale. For sale of other property. This is if a buyer needs or wants to sell his existing property before closing on the new one. So, and it is saying that, the buyer does not have to perform until they have received proceeds for the sale on their property and you put in their current address. And what is, this, we were seeing like none of this, in the last year or two when the market was so hot. If the market does soften, we'll probably see a lot more of this because, these are more popular in buyers markets than in sellers markets. And when the seller has a lingering property and is willing to take a chance, they do this one. So what happens is that if the buyer's first property doesn't sell by a specified date in there, then the contract ends and they get their earnest money back. So, and then if there's usually a kick out, meaning, and this is B, it says if seller accepts a written offer to sell the property, seller shall notify buyer of such acceptance. And the seller requires buyer to waive the contingency. Buyer must waive the contingency on or before blank day. Otherwise, the contract will terminate automatically. So some people, they'll go ahead and look at, buyers will look at houses that if it shows active kick out. And that means what you can do, a new buyer coming in without a contingency can kick out a buyer who has a contingency. So in this situation, let's say a house is under contract and the second buyer comes and he doesn't have to sell anything first. So he presents an offer. And if you were presenting an offer with something that was under kickout, okay, so you would use the backup addendum because it's contingent upon that first contract going away, being terminated. So, and if the first buyer is unable or unwilling to waive the contingency, they really can't move forward with buying, then this person who put in the second offer would now move up from backup to primary. And then sometimes, if push comes to shove, the person who has a contingency, they're able to do it. They just really don't want to do it. So they do it, meaning move forward with closing on the house. They will then agree to waive the contingency. And if they do that, you should have them put up extra earnest money just to show that, they are indeed serious and able to do it because you've turned away another buyer. Okay, inspector information. This is a form that isn't used that much. We encourage you to use it. It's basically saying we strongly recommend that you hire inspectors. And here's some names of several inspectors. And then they either say, I choose to hire an inspector or I choose not to hire an inspector. If you have a buyer client who is not wanting to hire an inspector, I absolutely recommend you using this form just so you have it documented that, you recommended and they chose that risk of not going forward. We had a lot of that happening again last year when the market was so hot. They're like, oh, we're going to waive inspections. They're just doing anything to get the house. So, and now people are coming back and saying, oh, you should have told me to get an inspector. This would protect you in such a situation. This is the buyer's termination of contract. It goes over the various reasons that a contract is being terminated. Of course, the first one is the unrestricted right to terminate under the buyer's option. Approval, can't get approval under third-party financing addendum. Doesn't appraise. The buyer elects to terminate under A, which is the mandatory membership of the homeowners association. If they haven't been given the seller's disclosure, that's another reason the buyer elects to terminate due to the condo contract and then other reasons. Next is the release of earnest money. This is the title company is going to want this. Often they don't require this if you're terminating per the option, but any other reason, including like the buyer not getting financing approval, they do want this. They don't want to be caught in the middle of a dispute. So both brokers and both the seller and buyer would need to sign this, and it's just saying how the earnest money is going to be distributed. Addendum regarding residential leases. This was a relatively new addendum that was added. It corresponds with the first page of the TREC contract. This is used when this is not having to do with seller leasebacks. This is if you are selling a property that the seller has leased. Either the whole property is leased, or maybe there's a back house and it is leased. So you would need to deliver that to the buyer along with a copy of the lease. And then if they have not received it, after they receive it, they have a blank number of days to cancel the contract. So again, it's sort of like the mandatory homeowners association contract. If they don't get it, they will it's good to have it up front so they don't have this extra out. Similarly with fixture leases, this has to do largely with solar panels and security systems. If something is being leased, they need to disclose it on page 1 of the contract and then have this corresponding lease. If they've got I think on this one, it is how many days? 7 days. They've got 7 days to cancel also. So again, if you know there are leases involved, get those up front when you have a listing. Hydrostatic testing. This is a plumbing test. And it can, very rarely, but can cause damage to a property. When a buyer is wanting to do that, they need to provide this notice and have the seller sign off on it. And you check who is liable. And oftentimes, I think if the buyer is wanting to do it, the buyer needs to be, say that they are liable for the damage. All right, next, registration agreement between brokers. There are 2 registration agreements. There is registration agreement between broker and owner, and there is registration agreement between brokers. I'm going to actually start with the registration agreement between broker and owner. Hey, Adam, did you know this class started at 9? Okay, you've been here the whole time? Okay, I didn't see you. I just saw Dottie. Okay, cool. Okay. I didn't know if you had just popped on at 10 o'clock. But I guess but okay, perfect. Okay, we're almost done. Okay, so registration agreement between broker and owner. So this is what is sort of sometimes referred to as a one-time showing agreement. So this has to do with a property that is not listed. There's no listing agreement. It's not an MLS, and you are could be one of 2 situations. Either you, let's say it's a potential client of yours, but they're not ready to list. It's like, no, we want to list next year. But you know someone who is wanting, maybe an agent has another client who is really wanting to see it. So what you would do in that situation is the owner would sign it, and what they do, you mention the property and the price, and you register. Number 4, registration, broker registers blank, and you would register one specific person. You would say, you would either say the person's name, or if you didn't know him, you would say client of, Susan Smith or whatever. And then the term of the agreement, it could just be for, the one showing. Usually it's a short period, and that they are going to give X amount. They're going to pay X amount. So the amount that would go here. So if you were going to effectively be the seller's agent, okay, so the seller and you're connecting them with someone who's bringing a buyer, you would put a full amount, like 6% in there, okay? So therefore, you would get the 3% for representing the seller, and the other agent would get the 3% for representing the buyer. And I'm going to jump back to the other registration agreement in a second. But a situation where you'd maybe only put 3% in there is if the seller wasn't represented. Let's say you know the seller and he really wants to act as a for sale by owner, okay? But you have the prospective buyer. Again, you register your buyer's name and you would put 3% in there because he's going to pay you a fee for bringing the buyer. Does that make sense? Yes.
So what if I
Wait, I can't hear you. Do you have volume?
Yeah. Hear me now? Is that better?
Nope.
Hello? No? Okay. I'll message you.
Okay. Let me go to the other document and then we can always talk offline about this because it's kind of confusing. So this situation is called the registration between brokers. So let's go back to the first scenario I gave you where somebody who is, you're going to represent him one time, just for this one time, you're representing the seller and another agent has a buyer. Okay. So when you put 6% in the other registration agreement, the registration between owner and broker, this is a registration just between brokers. Only the brokers are signing it. No buyer or seller is signing it. And you are agreeing to pay that agent 3%. You're going to share the commission with them. So you would put, you would be the listing broker in that situation. And then the cooperating broker would be the person bringing the buyer, the property, and then register. Number 3, you're registering that prospective buyer. And then you're saying down here that you're going to put 3% of the sales price. So you are paying them because here's the big distinction. Anything that's an MLS, when you are in MLS and you see something and it says BAC, which means buyer agent commission, that is in and of itself an agreement from the listing agent to the buyer's agent to pay that amount, to pay that buyer's agent commission. So we don't need this document. So this would also, so anything that is not on the market and not MLS, you need to address the situation. And that's what this document does. Okay, I see I have a couple of questions in chat. Thank you, CCR. Okay, so sorry, I hadn't been looking at my chat. So let's see, is there a form to request the CC&Rs? I don't know if there is a form per se. There is also the resale certificate. That's probably the best form to send to them. They're used to dealing with that, and that's a TREC form. But you would want that in conjunction with the CC&Rs, and that's where they're filling out kind of, oh, we have this amount of reserves and that. This is going back to the HOA. But I think just, finding the contact for the HOA management company is really the best way, and calling them, emailing them to get that. And again, it can take a while. So really be on the ball with that and try to start talking to them before you even get the listing active in MLS. Okay. Donna said, is there such thing of a recertification of a new survey? Let's see. A recertification versus a new survey. I don't know if I understand your question really, Donna. I mean, that's basically what the T47 is doing. It's saying it's still valid. Do you have a specific example?
Well, I'm also a broker. And
oh, you're muted. 1 second.
I'm unmuted now. Can everyone hear me?
Okay. Can you unmute?
Unmute. Okay. Can you hear me yet? My screen says I'm unmuted.
Angela.
I can't hear you.
I can hear you,
Okay,
Adam.
call me
Yeah.
afterwards. Call me afterwards. We'll
Okay.
talk. Okay, sorry about
Fine.
that. And then is there a place to request a type of survey? No, I think if there was a specific type of survey you wanted, you could put that in a special provision. Say this survey we want, or you want a topo survey, you know, something like that. I would put that in special provisions.
Thank you.
Okay, Angela, it is a setting. Oh, Adam's saying, oh, okay, sorry. I must have, this must have been about the thing. Okay, I need to figure out how next time I do a Zoom, I don't have everyone muted. So I apologize, but seriously, give me a call. Give me a call about the survey, Donna and Adam. If I can help you think through the registration agreements, I am happy to do that. Thank you guys for coming today and have a good rest of your day. Bye.
Bye.